Hi guys. So we're just gonna really run. Like gonna try to keep it as brief as possible. Yeah, I always say that, right? But anyway, you're welcome back to Grace's Word where Grace picks. Okay? So once you've determined your accounting period, which we already talked about, the next thing you should do is your posting, accounts posting. Okay, that's the very next step. Accounts posting. At the determined accounting period, you do what is called accounts posting. Now, what is posting? In accounting, posting is referred to, or posting means transferring the balances in the day books or journal into their appropriate accounts. Okay, so if you've recorded a credit sale like we mentioned in previous videos, if you've recorded a credit sale um in a journal proper for the credit for the debtor and as a sale, of course now you have the debtor's account, maybe Mr. T or Mr. J or whatever, you have his account and you have the sales account. Okay, so now transferring those entries into the into this account from the journals is what's called account posting. Okay, um you can actually do this as you go. You can actually do this as you go alongside recording. But then at the end of your accounting period, you have to balance up your account. Okay? But you have to determine the difference. Okay, quickly. An account is prepared in what is called a T format. So it goes this way. Okay? It goes like this. Did you see that? Like this. Okay? Um, so on this side you have the debit, on this side you have the credit. Oh, you guys have been waiting for that. Well, I finally did come to it. Okay, so you have the debit side and the credit side. On the debit side, you have the dates, the dates the transaction occurred, the particulars of that's the details of the transaction, and then the amount that was involved in the transaction. On the credit side, you have the same thing. Okay, now that's way more than I was gonna say about that. Okay, so balancing of the account means taking a total of the debit side and the total of the credit side and seeing if there's a difference. Most times there might be a difference. If there is a difference, it is either a balance carried down, which is a balance sheet item, or a difference which is simply taken to the income statement. Okay, so for instance, a sales account would not have a balance carried down. Like I said, I'll be talking about kind of transactions later, and I'll tell you why a sales account shouldn't have a balance carried down. But what you have, the difference on your sales goes to the income statement. Okay, but if it's an asset, for instance, debtors are assets. Okay, so if it's an asset, it would have a balance carried down, because if there's still a difference, it means that that guy is still owing you, so it's still an asset, so it's got to have a balance carried down. Okay, and the balance carried down will be the difference between the debit and the credit side, like I said, and it will be posted, to be used in the statement of financial position, which is also known to you guys as balance sheet. Okay, now the last thing I'm going to talk about accounts is this: an item could be a credit or a debit item. An item could be a debit or a credit item, meaning it could either be a debit posting or a credit posting. Okay, when we talk about the kinds of transaction, of course we'll not be able to talk about all, but we'll be able to talk about as many as we can. Okay, when we talk about that, you would know more about this. So this brings us to the end of today's session. Okay, so if by this time you have been following me and you wanna subscribe to my channel, I guess we should get powder. So like, if you haven't subscribed, please do that right now. Okay, just click on the subscribe button, turn on the notification bell so you don't miss any video. You get notified as soon as it's released. Invite people to subscribe to the channel so we can, let's push this ministry to the permanent site. Okay, thank you very much. See you next time. Bye bye.